You're thinking about retiring, maybe even a year or two early. You've got some savings in the bank, you've got a decent pension pot, and with no other income until your state pension kicks in, you'd figure just take the 25% tax-free cash out of your pension and use that to live on for a few years. It sounds simple, it feels like common sense, and in theory, it will work. But what if that decision, one that seems pretty obvious, is actually quietly going to cost you? Not in charges or in bad investments, but in less flexibility, needlessly lost tax-free cash, and just not as much freedom to adapt your income later on. What if you could retire at the same time, live on the same income, but finish up with more options, more control, and more tax-free cash when it really counts? Hi, I'm Toby. I'm a chartered financial planner based here in the UK. And on this channel, I'll help you make smarter decisions with your money. Now, this one's a real story. It happened in a gym. I've just finished a set and a guy I know, he knows what I do. He came over for a quick chat. He told me he was thinking about packing on work next year. He just had enough. He's got a decent pension, got some cash in the bank, and he told me that with no other income lined up until state pensions kicking in, his plan was to take his full tax-free lump sum and live off that in the meantime. And he asked me if it sounded like a good idea. And on the surface, that sounds totally sensible. He told me a financial advisor visits his workplace once a year to answer questions, and that's what they recommended. Now, I'm not here to slate that advisor, because what they said isn't wrong, but it came with no context. It's what I call a surface level answer to a deeper planning question. That wasn't really planning, that was just advice, and there is a difference. Advice tells you what you can do. Planning helps you figure out what actually makes the most sense for you. The advisor said you can take 25% of your pension tax-free and use that to live on. And yep, you absolutely can. But they didn't mention what happens when that lump sum runs out, how it affects your future tax situation, or that you could end up with the same income without giving anything up. Let me walk you through it using this real life scenario. So this chap, he's 62 and he wants to stop working next year. He has a pension worth £250,000 and savings of £30,000. With no other income until his state pension starts at 67, which will give him around 12 grand a year, he reckons he's going to need £20,000 a year to live on. So he's looking to cover 4 years with no income, and that's 80 grand in total. And at age 67, he needs to have enough spendable assets left to fund the difference between his state pension and his needs. And let's look at the two ways that he could do that. The first option, the financial advisor approach, or the lump sum approach. He takes the full 25% tax-free cash from his pension. That gives him £62,500. And that covers just over 3 years of his needs. In year 4, he takes £17,500 from his savings to make up the rest. And by the time his state pension kicks in at 67, here's what he's got left. £187,500 in his pension, but it's now all taxable, and he's got 12.5 grand left in his savings. It's not a disaster, but it's not very tax efficient either. And the most flexible part of his pension, the tax-free cash, that's gone. So now let's look at a different approach. This time, instead of taking that one big lump sum up front, he takes smaller amounts from his pension each year using something called UFPLS. That stands for Uncrystallised Funds Pension Lump Sum. It's a bit of a mouthful, but here's the important part. Every time he withdraws money, 25% of it is tax-free and the rest is taxable. But if he keeps that within his personal allowance, he won't pay any tax at all. So each year, he takes £16,760 out of his pension. That's £4,190 tax-free for 25% and £12,500 £570 of it is taxable, but this taxable part is still within his personal allowance, so there's no tax to pay. Then he tops it up with 3,240 quid from his savings, and that gives him the 20 grand a year he needs each year. And he does that for the 4 years. By the time he reaches 67, he still has £182,960 in his pension, and he's still got £17,040 in his savings. But here's the big one. He still has over 45 grand of tax-free cash available for the future. So he's had the same lifestyle, the same spending, and he has the same amount of combined pension savings left to fund the difference between his state pension and his year's needs. But he has more flexibility now, more assets to spend tax-free as he has more cash in the bank, and he still has all of that tax-free cash left within his pension. And here's another bonus. If the pension grows whilst he's drawing from it, let's say it climbs back to £200,000, his tax-free cash grows too. 25% of that is 50 grand, all still available to him. And that wouldn't have happened if it taken him a full lump sum up front. So, what's the key takeaway? The advice he got wasn't wrong, but it wasn't tailored to him. It missed the bigger picture. And that's why proper financial planning matters. Because it's not just about what you're allowed to do, it's about what gives you the most benefit now and later on. It's not about having a massive pension pot, it's about how and when you use it. If this helps you think differently about your own retirement plan, feel free to subscribe or share it with someone who's close to retiring. It might save them from making a costly mistake. Now remember, it's not just what you've saved, it's how you use it that makes the real difference.